Joining us now is Avery Shenfeld. He's chief economist at CIBC World Markets. He's one of Bloomberg's best. That means we bring you only the best people on the economy. We've crunched the numbers to find the most accurate forecasters in the world, and Avery makes the list. He's joining us now from Toronto. Thanks a lot for joining us. Obviously, we had a lot of economic data to sift through today. I want to start with jobless claims because there is a little bit of question about exactly what the numbers meant. The Labor Department itself telling us that there were some discrepancies because of the Easter holiday, and we can't quite necessarily take that number at face value. What's your read?
Well, I guess it's excuses, and there probably is some truth to, a shifting holiday makes it difficult to seasonally adjust because you don't get Easter in exactly the same week every year. But you can look at the 4-week average, which smooths out some of that, and it's still looking pretty lackluster. The reality is, it might be indicating something under 100,000 new jobs for April. And remember, it's been so long since we've had a good employment number. I mean, a really good one. We've forgotten what that looks like. That would be more akin to 250,000, 300,000 new jobs. That's what you'd like to see coming out of such a deep recession. And it seems like these numbers are telling us we're still away from that.
Sorry, when are we going to start seeing those kinds of numbers, 250, 300?
Well, I'm hoping that we see some of those in the quarters ahead. We'll certainly need to see that for the economy to be on a self-sustaining recovery, one that can continue without zero interest rates, without huge doses of further tax cuts or government spending, because we ultimately have to put money in consumers' pockets for them to finance more spending, some housing growth.
Well, the stimulus money that has been allotted already, not all of it has made its way into the economy. Do you think that there is enough to go there to last us until those jobs pick up and the economy can survive on its own?
I think so. I think if you combine that with the impact of very low interest rates, which are starting to have a bit more impact. It's been a long time now that the Fed, of course, cut those rates, but it took a while before at least the business sector in particular was able to access that credit. Households and small business still having a lot of problems accessing financing at those very low rates, but at least big business has found the bond market opening up its arms. That's creating at least a better investment climate. And we're hoping along with that then that we at least get the kind of employment growth that starts the unemployment rate gradually down over the next 6 months, enough to give us some elbow room for some consumer spending.
Well, Avery, we are seeing companies reporting some stellar earnings, as you're no doubt aware, but still on the jobs front, things are not picking up speed. We're still at an unemployment rate of 9.7%. Why are we seeing some reluctance from some companies to hire?
I think part of it is that perhaps we've mismeasured the recession. The gross domestic income numbers, which are supposed to be the same as GDP or not, showed a deeper recession. That may be part of it. Part of it may be that companies understand that some of the growth they're seeing now is temporary, related to the inventory cycle, related to things like Fed mortgage buying, incentives for home buying, that won't persist. Yeah. And I think some of it is, as you cited earlier, that small business sector that's still finding it tough to get credit to expand, and without that, they also can't hire the additional workers they'd like.
Right, and as we also know, youth unemployment numbers are terrible as well. I realize it's a few months ahead, but as young people start going on their summer vacations, what's that going to look like?
Well, some of them may be extended summer vacations, and more particularly, some people may end up staying in school longer. This is still, I think, for people graduating this year, going to be a pretty tough environment because they're competing with all the people who lost jobs in the past year and now have some experience trying to get back into the labor market. So it could be tough sledding for at least another year.
Avery, I want to ask you about rates and about inflation and also, importantly, deflation, which some folks have started to talk about. Do you think that's more of a risk now than inflation? And is that really going to tie the Fed's hands when it comes to raising rates?
I think you have to be more worried about deflation anytime you're talking about a 9.7% unemployment rate, huge labor market slack. There isn't the income to drive prices higher. So yes, some things can go up, but you need savings somewhere else for the household budgets to balance, essentially. So the Fed is still very much in the mode of saying, look, we've got an economy with acres of slack, oceans of unemployment. We need to keep the stimulus on full throttle until this economy has generated enough jobs, and that's at least a few quarters away, so that it can live with higher interest rates. I think Bernanke has it right. Extended period of very low rates, and I think extended means quite a long time.
Avery, just a very quick question here. Don't have much time left. We talked to a Brandeis University professor yesterday, Catherine Mann, and she said the risk with keeping rates these low is that you start to fuel an asset bubble, particularly when you look at equities. Do you think that's a risk at all?
I think it is true you're pushing equities up hard and fast, but remember, they came from a pretty severe trough. They're still down from the peaks in many cases. But more importantly, you can't have it all ways. You only get one interest rate setting, and it has to be appropriate for the economy as a whole. So like we saw in some past cycles, sometimes you risk building a little bit of a bubble in one part of the economy because there are other parts of the economy that still very much need that medicine.
Avery Shenfeld, CIBC World Markets chief economist and one of Bloomberg's best. Avery, thanks.